Donald Trump's tariff suspension deadline is set to expire on July 9th. With just a few days left, Washington will be sending out letters to trade partners with tariff rates detailed out.
It began quietly, like most trade disputes do. A warning here, a speech there. Then came the number, 17%. That is the tariff the United States, under President Donald Trump's administration, is now threatening to impose on European food exports.
We've done the final form, and it's basically going to explain what the countries are going to be paying in tariffs. And it's very important. It's a lot of money for the country, but we're giving them a bargain.
The announcement did not come with fireworks. It arrived in a private meeting behind closed doors, delivered as a strategic signal during tense negotiations between U.S. and European Union officials in Washington. For many Americans, that number might seem arbitrary, but to European exporters, American importers, and everyday shoppers standing in grocery aisles, it is far more than just a policy detail. It is a potential price hike. It is an economic shock. And it is a reminder that global trade, while often invisible, touches nearly everything we eat, buy, and depend on. The threat came during broader talks between U.S. officials and EU Trade Commissioner Maroš Šefčovič. The topic was much larger than just food. At stake was an entire transatlantic trading relationship. The Trump administration has been pushing a sweeping plan that could see tariffs rise across a range of goods, from cars to steel to consumer products, if new deals are not finalized by the self-imposed deadline of July 9th. But in that meeting, food took center stage. A specific warning: if Europe does not concede enough ground, the United States could slap a 17% tariff on agricultural goods,
depending on the country's trade engagement with the United States. However, European Union believes it is a challenge to reach an agreement on such high volume of trade with the United States. EU Commission Chief Ursula von der Leyen says that EU member states will be prepared for a no-deal scenario.
That message was passed from the White House to EU trade officials, and within hours, it was rippling through diplomatic circles across the Atlantic. European diplomats were stunned, but not entirely surprised. The tariff fits into a wider strategy. Earlier, Trump had warned of increasing baseline tariffs on most EU goods to 20%, with 50% levies on European automobiles and metals. Those threats were temporarily paused, but they remain on the table. The 17% tariff on food is a sharper, more focused tool, one that hits households directly. It targets not factories or corporations, but farms and families, and the impact, if it happens, would be felt immediately. Europe exports a wide variety of food products to the United States. French cheeses, Italian cured meats, Spanish olive oil, Belgian chocolates, Irish butter, all of these would suddenly face a new cost barrier. A 17% tax collected at the border. Importers could try to eat the cost. Producers might lower margins, but in most cases, the price would simply rise. At supermarkets across the United States, consumers would find familiar products more expensive or suddenly missing from shelves. European producers know what this means: lost revenue, lost market share, and potentially lost jobs. Some may try to redirect their exports elsewhere, but the US market is hard to replace. For many mid-sized producers in France, Spain, or Italy, the United States is not just a customer, it is the customer. Losing access or being priced out would deliver a painful financial blow. Analysts say the overall impact on the EU economy might appear small in percentage terms, a fraction of gross domestic product. But that statistic hides deeper problems. The effect would not be felt equally. Agricultural regions in Ireland, southern France, and rural Spain might feel the full weight of these tariffs. For small farmers or artisanal producers, losing the US market could be devastating. At the same time, American consumers would not escape unscathed. A tariff on imports is a tax. One way or another, the cost gets passed down. That means a bottle of olive oil that once cost $10 might now cost nearly $12. A wedge of French cheese becomes a luxury. A holiday bottle of champagne turns into a budget reconsideration. In a time when many American families are already grappling with higher costs, especially at the grocery store, this kind of targeted price increase cuts deep. And it is not just food. When tariffs rise, inflation rises with them. Economists have warned that tariffs like these help push overall consumer prices higher. Even modest increases add pressure on household budgets, feeding into broader economic trends. Rising grocery bills can shift spending habits, reduce discretionary purchases, and ripple through the retail sector. What starts as a trade decision in Washington ends up influencing dinner tables across the country. Some might argue that American producers could benefit. If European goods are priced out, that space could be filled by domestic alternatives: a US-made cheese, a California wine, a domestic olive oil brand. But the reality is more complex. Many European food items have no perfect substitute, and even when alternatives exist, the shift takes time. Meanwhile, importers, retailers, and restaurants face confusion and disruption. And retaliation remains a looming threat. The European Union has already stated that it will not sit still. If the United States imposes a 17% tariff on food, Brussels is prepared to respond. Officials have hinted at counter-tariffs on iconic American exports: whiskey, aircraft parts, industrial machinery. In short, a tit-for-tat escalation that risks dragging both economies deeper into confrontation. The global ripple effects are harder to predict, but no less real. When the Trump administration first introduced new tariffs earlier this year, global financial markets responded immediately. Stock indexes fell, bond yields dropped, investors fled to safe haven assets like gold. In just one day, the US stock market lost nearly 5% of its value. Traders understood the signal. This was not a one-off policy, it was a shift in the rules of global commerce. More recently, as the July 9th deadline approaches, European stock markets have started to react. Major indexes in Germany, France, and Spain have posted losses as uncertainty grows. Industrial firms, exporters, and banks have been among the hardest hit. Even the possibility of tariffs has been enough to shake confidence. Currency markets, too, are in flux. The US dollar has strengthened on fears of global instability. Oil and commodity prices have softened. All of it points to the same underlying fear, that a new wave of trade protectionism could slow global growth and unsettle already fragile economies. It is a familiar story. We have seen versions of it before. During the previous Trump administration, tariffs were used as leverage in disputes over aerospace subsidies. The Airbus-Boeing battle led to tit-for-tat taxes on wine, cheese, and whiskey. In those cases, consumers paid more, businesses scrambled, and governments eventually struck uneasy compromises. The 17% food tariff feels like a return to that playbook. But this time, the stakes may be even higher. The current global economy is more fragile. Supply chains are stretched, consumer budgets are thin, and inflation, though lower than its 2022 peak, remains a political and economic concern. If these tariffs are enacted, experts warn, they will push inflation higher, shave points off growth, and trigger new rounds of political tension. The Organization for Economic Cooperation and Development has already revised its global growth forecast downward, citing trade tensions as one of the key risks. A world economy already struggling to regain momentum after a series of shocks does not need another. And yet, that is exactly what may be coming. The Trump administration has made clear that if no deals are signed by August 1st, formal letters will be sent outlining new tariffs, some as high as 70%. For Europe, the clock is ticking. Officials are racing to finalize a limited deal that would preserve a 10% baseline tariff on most goods and shield key sectors from escalation. But divisions remain. Germany and Italy reportedly favor compromise, aiming to protect industrial exports and jobs. France has taken a harder line, insisting that any deal must be fully reciprocal. That means US goods would face the same tariffs as European ones. Without unity, the EU's negotiating position weakens, and in the background, producers, retailers, and consumers wait. For European farmers, it is a countdown to potential disaster. For American importers, it is a question of survival. For everyday shoppers, it is another unpredictable shift in the cost of living. The trade deadline is not just about contracts. It is about confidence. Investors want predictability. Consumers want stability. Businesses want clarity. But with every new threat, 17% here, 50% there, that clarity fades. YouTube is not the biggest fan of content like this, but we believe people deserve to hear the truth. If you agree, hit that like button and subscribe. It helps us beat the algorithm and keep going. We really appreciate the support. If no agreement is reached by July 9th, and if the United States follows through on the food tariff, the effects will be felt almost immediately. Prices will rise, exports will fall, tempers will flare, and what began as a single line item in a trade negotiation could become a catalyst for a broader breakdown in US-EU economic relations. It is still possible that cooler heads will prevail. Some in Washington believe the tariff threats are simply leverage, tools to force better deals. Some in Brussels hope that even a limited agreement can buy time. But every day without resolution brings more uncertainty. And every new tariff, real or proposed, chips away at the trust that has underpinned transatlantic commerce for generations. This is not just about cheese or wine. It is about the fragile web of economic ties that connect two of the world's largest markets. If that web begins to unravel, the consequences will extend far beyond a supermarket shelf. They will shape inflation, investment, wages, and policy for months, if not years, to come. And that is why the 17% food tariff matters. It is not just a number, it is a signal, a turning point, a warning that what was once stable is now uncertain, that what was once taken for granted, open trade, low prices, reliable supply, can no longer be assumed. The coming weeks will reveal whether that warning becomes reality or whether diplomacy can still pull this relationship back from the edge. Until then, the markets will watch, the negotiators will press, and the public, on both sides of the Atlantic, will brace for what comes next.